Welcome back to Late Night Wealth Radio. Before I dive into my investing tips today, let's get on the same page about one fundamental idea. This is exactly what separates new investors from the absolute pros. Investing is never some mystical guesswork, and it's definitely not gambling. It's a rigorous science. A lot of people treat the stock market like a legal casino. They chase rising stocks and dump losing ones non-stop, chase rumors left and right. When they make money, they think they're geniuses. When they lose, they blame bad luck. Let me be clear, that's not investing at all. It's just mindless gambling with terrible odds. True long-term value investing works just like physics or medicine. It follows logical formulas, relies on proven data, and abides by unbreakable objective rules. Section 1. Judgments driven by emotion often stray from reality. Since investing is a science, we have to confront its biggest variable, human emotion. Science is all about objective facts, yet our minds simply don't act rationally when money is on the line. Here's the hard truth we'll break down first. Our gut calls fueled by emotion are almost always way off from what's really going on. When a stock keeps soaring, your emotions scream, "It'll keep going up. Buy now or you'll miss out on big money." That's greed talking. When the market crashes hard, fear kicks in hard, pushing you to sell your shares in a panic. This isn't just a problem for new investors. Even the greatest minds in history fell for it. Let me share a classic true story, Isaac Newton and the South Sea Bubble. Case 1. How genius Isaac Newton got burned in the market. Back in 1720, the famous South Sea Bubble swept across Britain. Fueled by wild speculation and false hype, shares of the South Sea Company kept skyrocketing. As one of the greatest scientists of all time, Sir Isaac Newton stayed rational at first. He bought some stocks and sold them calmly once the price doubled, pocketing 7,000 British pounds. If the story had ended there, he'd have come out a wise man. But the real trial was yet to come. After Newton sold, the market didn't cool off as he'd predicted. Instead, driven by mass hysteria across London, the stock price surged even more wildly. Watching people far less intelligent than himself get rich quick day after day, Newton was consumed by intense FOMO, fear of missing out, and envy. Blinded by his emotions, he set aside his scientific reasoning entirely. At the absolute peak of the nationwide speculative frenzy, he poured his entire fortune into the stock. It wasn't long before the bubble burst and share prices crashed hard. Newton lost a whopping £20,000 in the collapse, a sum equal to decades of his salary. After the disaster, the man who discovered the law of universal gravitation uttered this famous, despairing line: "I can calculate the motions of heavenly bodies, but I cannot calculate the madness of men." If a brilliant mind like Newton can make judgments totally out of touch with reality when ruled by emotion, what chance do ordinary people have? Every call you make based on gut feeling and mood will most likely lead you straight into classic traps, buying at the top and selling at the bottom. Section 2. Analyze market emotions with a scientific approach. So how can new investors fight against these innate human instincts? That's what we'll talk about here, learning to interpret market emotions scientifically. The scientific approach doesn't mean getting rid of emotions entirely. Instead, we treat market sentiment as a measurable indicator. Benjamin Graham, the father of value investing, came up with the well-known concept of Mr. Market. Essentially, analyzing emotions scientifically is all about turning subjective panic and euphoria into hard, objective data. I'll walk you through two powerful real-life cases, one positive, one negative, to show you just how effective this method is. Case 2, think scientifically and go against the crowd. Buffett buys the Washington Post during the downturn. In 1973, the U.S. stock market was stuck in a prolonged bear market. The Watergate scandal triggered political unrest, and panic swept across the entire market. Shares of the iconic The Washington Post were dumped heavily, plummeting from their peak. Everyone else wanted to sell and run for the exits, convinced the newspaper business was doomed. But Warren Buffett kept his emotions in check and ran the numbers using proven value investing frameworks. He found the company's total market value had dropped to just $80 million. The hard data told him something striking. Even under the worst circumstances, if they sold off its printing plants, office buildings, and brand assets separately, the whole business could fetch as much as $400 million. Driven by widespread fear, the market was essentially selling this profitable business at a ridiculous 20% of its true worth. Buffett relied on solid data to block out negative sentiment and took a huge position without hesitation. Over the next decade and more, this contrarian, data-driven investment delivered returns of over 100 times. It stands as a perfect example of cutting through emotional noise with science. Case 3, the cost of pseudoscience, the collapse of the LTCM legend. You might be wondering by now, if investing is a science, do smarter mathematicians and sophisticated models guarantee bigger profits? Let's look at this classic cautionary tale. Back in the 1990s, Long-Term Capital Management, LTCM, a high-profile hedge fund on Wall Street, took the financial world by storm. Its team was an all-star lineup of intellectual elites. Among them were a former Federal Reserve vice chair, plus 2 world-class mathematicians and economists who'd won the Nobel Prize in economics. They built an extremely complex mathematical trading model. Using computers, it hunted for tiny price gaps across global bond markets to make arbitrage profits. For the first few years, the model worked flawlessly and delivered staggering returns. Fully convinced their system was purely scientific, they cranked up leverage to an extreme level dozens of times over. But they made a fatal mistake. Their model relied entirely on probabilities drawn from historical data and treated extreme market sentiment and black swan events as scenarios with zero chance of happening. In 1998, Russia suddenly defaulted on its sovereign debt. Panic spread across global financial markets overnight. Investors rushed to buy US dollars and dumped every other asset at any cost. This market frenzy driven by sheer terror was way beyond every scenario programmed into the Nobel laureates' models. Faced with overwhelming mass emotion, their seemingly flawless, genius-built scientific model broke down completely. In just 150 days, this financial giant with over $100 billion in assets collapsed and went bankrupt. This story drives home a key lesson. True investment science means not only valuing businesses with calculations, but also respecting market sentiment rationally. We have to accept that human hysteria can never be fully quantified by any model. Chapter 2 Intro, some personal investing tips. Alright, we've wrapped up Chapter 1, and now you know the unvarnished truth about the market. We get that investing is a cold, hard science, and we've seen firsthand how gut feelings and emotions get crushed, even destroyed, by the market's massive waves. But here's the thing, understanding the theory and actually making money in the market are worlds apart. Wall Street's never short on brilliant mathematicians or Nobel laureates, but plenty of them end up bankrupt. That proves it. In the money game, knowing the scientific map matters, but what matters more is whether you can stick to your rules when you're out there alone in the dark. At the end of the day, investing isn't about how many fancy financial models you know. It's about whether, when the market's at its most manic or most desperate, you can act like a robot, following those ironclad rules that go against every human instinct. In Chapter 2, I'm laying out 4 lifelong investing lessons I've learned from years in the trenches, and yes, from paying some brutal tuition along the way. These 4 tips have zero complex math. They're painfully simple, but that's exactly why 90% of new investors roll their eyes when they first hear them. It's only after getting pummeled by the market that they realize why the legends on the mountaintop repeat these basic truths their whole careers. I call them the 4 beacons, the most stable guideposts for regular folks navigating the financial ocean. If you want your wealth to grow with compounding long-term and move up the ladder, settle in and listen up. These are your 4 non-negotiable rules. First up, stick to what you know, only bet on what you understand. Welcome to Chapter 2. Now that we get investing is a science. Let's turn that science into unbreakable rules. My first tip is 10 words. Stay within your circle of competence. Profit only from what you understand. Warren Buffett made this famous with his circle of competence theory. He said, "Success in investing doesn't depend on how big your circle is. It depends on how well you see its boundaries and how fiercely you stay inside them." New investors make one huge mistake, chasing whatever's hot. One week it's EVs, they jump in without even getting how batteries work. The next, it's AI, they pile in without knowing what a large language model is. They think follow the crowd fast equals easy money. But the truth, investing outside your understanding is just gambling, handing your fate to strangers. To drive home the power of sticking to your circle, let's look at 3 real-life stories, spanning history, legends, and everyday people. Case 1, Buffett stays in his circle, avoids the 2000 dot-com bubble. Our first case is one of the most legendary wins in value investing history. Back in the late 1990s, the US was caught up in the wild dot-com bubble. Any company with a com in its name could double in a day. Every fund manager on Wall Street was crazy over tech stocks. Old school industries were written off as worthless. Faced with one of the biggest wealth frenzies ever, Buffett made a call that got him mocked nationwide. He didn't buy a single tech stock. At the 1999 Berkshire Hathaway shareholder meeting, reporters and investors grilled him non-stop. Some media even called him too old, out of touch, stuck in the past. Buffett took the heat and said calmly, "The internet will change the world, sure, but I can't tell which companies will survive. It's outside my circle of competence, and if I don't understand it, I won't touch it." By 2000, the bubble popped hard. The Nasdaq crashed nearly 80%. Countless unstoppable tech giants went under in months. The fund managers who mocked Buffett, many went bankrupt. Meanwhile, Buffett stuck to what he knew: consumer staples, insurance, old economy stocks. He didn't just avoid losses, his wealth hit new highs. The lesson from the legend, proven over decades: in the stock market, being wrong isn't fatal. Not knowing your own limits is. Case 2, mastering simple business. Buffett and Coca-Cola's compounding legend. Now that we've talked about staying within your circle of competence, what does it really mean to truly understand a business? Let's take a look at Buffett's iconic investment in Coca-Cola. In 1988, Buffett started buying Coca-Cola shares in large quantities. Back then, plenty of people were confused. Why pour money into a company that just sells sugary soda? But from Buffett's analytical perspective, Coca-Cola ran an incredibly straightforward and rock-solid business, right at the core of his circle of competence. He crunched the numbers this way: people need to drink water every single day, and Coca-Cola boasts an unbeatable brand moat. Even a tiny 1-cent price hike per bottle, multiplied by billions of consumers worldwide, would translate into enormous profits. More importantly, no matter how technology evolves, people will still need beverages 100 years from now. This business will never be disrupted by new tech trends. A business you can see through and fully grasp is the perfect fit for your competence zone. Buffett held this investment for over 3 decades. The annual dividends alone have long surpassed his original principal. At the end of the day, earning money from businesses you understand is the steadiest and most stress-free way to build wealth. Case 3, an ordinary man's success story. The gas station attendant who built $1 million fortune. You might be thinking by now, Buffett is a once-in-a-generation genius. Us regular folks don't have his vision, so how do we find our own circle of competence? Let's dive into the third story about an everyday person just like you and me. There was an American named Ronald Reed. He only held 2 jobs his entire life: a gas station attendant and a department store security guard. He earned a modest income, never went to college, and knew nothing about Wall Street's complex derivatives. Yet when he passed away in 2014, at the age of 92, he left behind a staggering $8 million estate, shocking the whole country. How did a gas station worker pull this off? The answer is simple. He stuck firmly to his circle of competence. Throughout his life, he only invested in companies he saw, used and relied on every single day: major retail chains, railroad firms, and utility stocks. He never followed tips from Wall Street analysts and simply ignored any stock that lay outside his understanding. His decades-long journey proves a powerful truth. Even if your circle of competence is tiny, hold fast to it. With the power of long-term compounding, anyone can build their own lasting wealth. Stick to your circle of competence. Staying within your circle of competence helps you steer clear of 90% of the market's deadly traps. Honestly, nail this one rule, and you'll already be on solid ground in the stock market. Yet new challenges still lie ahead. Even if you're as sharp as Buffett, and every asset you buy falls squarely within your expertise, unexpected crises are inevitable. Wars, global pandemics, once-in-a-century financial crashes, these black swan events are beyond anyone's control. They can drag even a well-built portfolio down in an instant. Imagine you put all your money into a rock-solid company you fully understand, only to see the whole market crash the next day. Do you watch your wealth shrink in despair, or get ready to grab great bargains? That brings us to the second vital rule for survival. This isn't just about numbers. It's the ultimate shelter and reserve ammo in value investing. Now let's move on to Rule 2. Always keep half your cash on hand. After hearing the first rule, many of you might think, now that I've found great companies I understand, why not go all in and make a killing? My second rule may go against your gut and sound overly cautious, but take it to heart. No matter how booming the market looks, no matter how confident you are in your picks, always keep roughly half your capital in cash. New investors love to go all in. When stocks rally, they even dip into money set aside for rent just to pour more into their trading accounts. To them, idle cash is useless and gets eaten away by inflation. But top long-term value investors see it totally differently. Cash is far from a dead asset. It's your most powerful strategic weapon and your safest shelter. Why hold on to half your cash? Because the market is wildly unpredictable. History has proven time and again, only those who keep reserves can pick up true gems when everything falls apart. Let's look at 3 dramatic real stories from Wall Street. Case 1. Buffett's secret weapon: billions in cash during the 2008 financial crisis. First, let's see how the legend of value investing put cash reserves to work. Back in 2007, right before the U.S. subprime mortgage crisis hit, the global economy was thriving and U.S. stocks kept hitting record highs. Many fund managers mocked Buffett because Berkshire Hathaway held over $40 billion in cash. While everyone else rushed to buy stocks, he sat tight with massive reserves. Then 2008 arrived. Lehman Brothers collapsed, and a historic financial tsunami swept across the globe. Major U.S. financial giants teetered on the brink of bankruptcy within days, and their share prices became nearly worthless. Panic gripped Wall Street, and almost no one had any spare capital left. At that moment, Buffett's $40 billion cash pile became America's last lifeline. The chairman of Goldman Sachs personally called him for help. Buffett stayed calm and set his terms. Goldman had to issue $5 billion in preferred stock to him, paying a hefty 10% annual dividend. Soon after, General Electric and Harley-Davidson also came begging for his financial support. Thanks to the cash he never touched, Buffett bought stakes in America's top-tier enterprises at rock-bottom prices during the market's darkest hour. Once the crisis passed, these investments earned him well over $10 billion in pure profit within just a few years. That's the offensive power of holding cash reserves. Case 2. The fall of a trading legend: Jesse Livermore ruined by going all in. If Buffett's story shows how powerful holding cash can be, this one reveals the devastating consequences of keeping no reserves at all. Let's talk about Jesse Livermore, the original stock market legend. Livermore was a gifted trader. During the historic 1929 U.S. stock market crash, He made $100 million in a single day by shorting the market, cementing his status as a financial icon of his era. Yet he had a fatal flaw. He always maxed out leverage and deployed every last dollar. To him, letting cash sit idle was a waste of his talent. Every time he scored big gains, he immediately went all in on new trades. After his huge windfall in 1929, he believed he had mastered the market. In the years that followed, he kept buying the dip with full positions. But the Great Depression turned out far worse than anyone anticipated. The market just kept falling, with no true bottom in sight. With zero cash left for protection, Livermore had no extra capital to average down during relentless market plunges and volatile swings. What's more, his full positions and heavy leverage led to repeated margin calls and forced liquidations. By 1934, this once hugely successful trading star filed for bankruptcy. In 1940, overwhelmed by despair, he took his own life. It was never his trading skills that defeated this genius. It was his stubborn habit of leaving himself no safety net by always going all in. Case 3, cash as your safety net. Two different outcomes during the 2020 market circuit breakers. You may think these are just tales of Wall Street giants and have little to do with regular people. Let's look at what happened to everyday investors when the COVID-19 pandemic hit in 2020. In March 2020, US stocks triggered an unprecedented 4 circuit breakers in just 2 weeks. Share prices of many solid companies halved within days. Even tech giants like Apple, Microsoft, and Amazon lost more than 30% of their value. Two totally different fates unfolded for ordinary investors back then. The first group had gone all in long before the market turmoil. They watched their portfolios lose tens of thousands of dollars day after day. To make things worse, they barely had enough money left for rent and daily expenses. Crushed by cash shortage and panic, they sold off their quality shares at rock-bottom prices right before the final market rebound. The second group stuck firmly to the rule of keeping half their capital in cash. While their stock holdings also dropped, the solid cash reserve in their bank accounts kept them calm. Instead of panicking, they felt upbeat. Top-tier assets they could never afford before were now on heavy discount. During the third and fourth trading halts, they deployed their spare cash gradually to pick up bargains. Just 1 year later, the market staged a strong recovery. Those who held cash saw their wealth double, and many even moved up a financial class. Keep half your cash at all times. In good times, it keeps you rational. In crises, it serves as your lifeline. A full stomach keeps a peace of mind. With a clear map of your circle of competence and half your capital held as cash reserves, statistically speaking, you've joined the top 1% of investors who are tough to beat in the market. But here's the truth: the real challenge has only just begun. When a market tsunami hits, panic spreads everywhere, and your heavily held stocks, the ones you thought you fully understood, lose half their value in days. Even with cash on hand, will you actually dare to hit that buy button? At its core, investing is never about complex math models or how much capital you have. It's an inner battle against fear, greed, and anxiety. Why do many top-tier university graduates lose heavily in stocks, while ordinary people with steady minds grow their wealth steadily? Now let's move on to the core mindset strategy in this guide. Rule 3: maintain a sound mentality. Your circle of competence acts as your shield, and cash reserves serve as your ammunition. Tactically, you are well protected. Now take a moment and face the harshest battlefield in investing. It's not on Wall Street or inside trading floors. It exists deep within yourself. Here is my third golden rule. In investing, state of mind always matters more than raw intelligence. A steady mindset is what truly separates successful investors from the crowd. New investors often believe stock trading relies on IQ, advanced math, or the ability to decode complicated financial statements. Let me share a harsh industry reality. Smart people are actually more likely to go bankrupt in the market. The stock market preys on human weaknesses, and shatters rational thinking. If you check your portfolio dozens of times every day, get restless when prices rise, lose sleep and appetite when prices drop, or even lash out at your family out of stress, you will never hold on to great stocks, even if they are set to surge 100 times over. Your mentality will collapse long before your finances do. Let's look at 3 powerful real stories to see how mindset makes or breaks your wealth. Case 1. A genius undone by restlessness, the Masayoshi Son-style anxiety mentioned by Duan Yongping. First up, an investment giant with extraordinary talent and vision, yet ultimately defeated by his own mindset. Masayoshi Son, founder of SoftBank, is undoubtedly a legend of his era. His most iconic move was investing $20 million in Alibaba back in 2000. That single bet eventually ballooned into tens of billions in returns, making him world famous. He grew overly confident in his own judgment, almost believing he could never go wrong. Over time, that overconfidence turned into crippling anxiety. He was desperate to replicate another success like Alibaba and terrified of missing the next big trend. Driven by restlessness and fear of falling behind, he launched the massive Vision Fund worth hundreds of billions of dollars. In a reckless rush, he poured money into countless unprofitable unicorn companies at sky-high valuations. The most striking example, after just a dozen minutes of conversation with WeWork's founder, he invested billions in a fit of overconfidence and recklessness. As we all know, WeWork eventually collapsed, and the Vision Fund posted one of the worst losses in tech investment history. Renowned value investor Duan Yongping once commented on Masayoshi Son, "He has an exceptional eye for opportunities, but his mind is far too restless. His obsession with chasing huge wins is fatal in investing." Case 2. Even market legends lose their cool, the shared tragedy of Peter Lynch and retail investors. If Masayoshi Son's story feels distant, let's turn to Peter Lynch, Wall Street's most celebrated fund manager, and the ordinary investors who followed him. During his 13 years managing the Magellan Fund, Peter Lynch delivered an annual return of 29%. That means an initial $10,000 investment would grow to $270,000 over the period. It should have been a win for everyone. However, Fidelity later released a startling set of statistics. More than half of retail investors in this star fund ended up losing money. How could this happen? It all came down to their volatile trading habits driven by emotion. Whenever the fund's net value dipped by a normal 10% amid market swings, fearful investors would sell their shares and redeem their holdings in frustration. When the fund rallied to new highs, greed took over, and they piled in recklessly at peak prices. Their poor mindset turned a hands-off wealth-building miracle with 29% annual returns into heavy losses. Peter Lynch left the investment world a timeless warning. Your ultimate success or failure in investing is often decided by your mental resilience, long before you place a single trade. Case 3. A layperson's Zen mindset, the elderly lady who left her account untouched for a decade. We've seen geniuses and regular investors ruined by poor mentality. Now here's a wise story about an ordinary person. A well-known tale circulates among Chinese investing circles. An elderly lady with no knowledge of stock analysis or macroeconomics followed her family's advice and bought shares in a stable blue-chip company using her spare cash many years ago. After buying, she did something most Wall Street elites could never do. She locked her account password in a drawer and simply forgot about the investment entirely. Over the next decade, the market saw wild bull runs and devastating crashes. Countless smart people who checked prices daily and traded frequently kept losing money amid anxiety and panic. Meanwhile, the elderly lady lived a peaceful life, drinking tea and joining square dances, completely unaffected by market chaos. 10 years later, she needed to update her bank card and reopened the long-forgotten account with her son's help. To her surprise, thanks to avoiding emotional stress and repeated trading fees, Her original savings had multiplied more than 10 times, boosted by compound interest and reinvested dividends. In the end, true value investing is a form of spiritual practice. The calmer your mind is, the less market fluctuations will bother you. Master the rules, ride the trend. If you treat investing as a science, stick firmly to your circle of competence, keep half your cash in reserve, and build an unshakable mindset amid market chaos, you've fully made the leap from a new investor to a seasoned one. Now, before we wrap up today's session, I'm going to share the final secret that can take your wealth to new heights and define your financial future. This is the fourth and most crucial rule of all. Many value investors manage to avoid losses their whole lives, yet only earn modest returns. They play it safe within their comfort zones, but miss out on massive wealth booms brought by the times. Why? They only know how to defend, not how to ride the unstoppable tide of human progress. Ordinary investors who turn a small sum into hundreds or even thousands of times their original capital within 2 decades and completely change their social and financial status live by just 4 simple words. This is also the little-known key behind Buffett's trillion-dollar fortune. Let's dive into the core lesson for today. Rule 4, go with the trend. New investors usually link this phrase to technical analysis, studying candlestick charts, spotting price breakouts, and trading on trading volume. But when it comes to long-term value investing, the trend we talk about refers to the irreversible growth of an era, the advancing pace of technology and civilization. No talent can stand against the tide of time. Individual wisdom means next to nothing when faced with sweeping historical trends. Buffett has repeatedly called his greatest fortune a winning lottery ticket. He was simply born in 20th century America and lived through 100 years of booming economic and national growth. That is the ultimate example of going with the trend. To drive this point home, let's look at a bitter real-life story that contrasts following the trend with fighting against it. From the 1990s to the early 2000s, Bill Miller was a legendary fund manager on Wall Street. He beat the S&P 500 index for 15 consecutive years, earning him the reputation of an unbeatable investing guru. Miller was a die-hard value investor. In 2007, signs of the U.S. subprime mortgage crisis emerged, and major Wall Street firms struggled with severe liquidity crunches. Bear Stearns, one of America's top investment banks, saw its stock price collapse after loading up on toxic assets. This was the fateful turning point for Miller. Using value investing metrics, he believed the firm still held solid assets, and the sharp drop was nothing but market panic. He decided to buy the dip. He poured large sums into Bear Stearns, as well as other troubled giants including Lehman Brothers, Freddie Mac, and Citigroup. He thought he was following Buffett's mantra, be greedy when others are fearful. He was convinced these industry leaders would bounce back once the crisis passed. But he made a critical mistake. He went against the collapse of trust across the global financial system. Shortly after Lehman Brothers filed for bankruptcy, Bear Stearns was sold at a fire sale price, and Freddie Mac was taken over by the government. Those seemingly undervalued stocks crashed to nearly zero within months. Miller's fund plummeted 55% in 2008. All his gains from over a decade vanished, and countless investors lost their life savings. The once celebrated star eventually stepped down in disappointment. Miller's failure boils down to one thing: he fixated on cheap valuations but ignored the bigger picture. The era of reckless financial leverage was coming to an irreversible end. When a major trend is collapsing, seemingly bargain-priced stocks are nothing but deadly traps. What does it mean to truly go with the trend? Real trend following means identifying industries over the next 5–10 years that society cannot live without and whose demand will only rise, regardless of stock charts. Let's look back to late 2022, when ChatGPT exploded onto the global tech scene. To follow that trend, you didn't need to guess which AI startup would survive. You only needed basic value investing logic. Whoever wins the AI race will need massive computing power and chips. Thus, the absolute leader in compute chips, NVIDIA, became the ultimate trend of this era. Long-term investors who recognized this tech shift in early 2023 bought NVIDIA and held on tight have shared in one of the most extraordinary wealth surges in tech history. New investors often make one critical mistake. They try to outsmart the market, catching falling knives and buying cheap stocks in sunset industries. They think they're buying the dip, only to be abandoned by progress. Remember, in the vast ocean of investing, we don't create the waves, we surf them. Ride the current, and you'll go far with little effort. Fight the current, and you'll be crushed on the shore.